Even though the market is currently down for the year, it is still massively overvalued, but that's okay. We're here to help you navigate the market, whether it's up a lot, down a lot, to make you a great investor in any market. Because in the long run, stocks are a weighing machine. In the short run, they're a voting machine. And right now, in the short run, in the recent week, it's been down. But we have no idea how the year is going to end. There's always those stats about the first month of the year drives the rest of the year. Could very well be, but we don't know what's going to happen. What I do know is we're coming off our second year in the row in which the S&P 500 was up more than 20% in back-to-back years. The last time that happened, I believe, was 1997 and 1998. In the middle of the economic and stock market boom of the late 90s. How did it end? 2001, 2, and 3, for the first time since the Great Depression, had 3 years in a row of losses. Does that mean it's going to happen here? Not necessarily. Now, the big mistake I've made in investing is I used valuations to drive timing of the market. That was wrong. But valuations are great for expectations of the market. What that means is when values are high, when you're paying high prices for stocks, your returns are lower. And right now, the projected returns on the market over the next 10 years are not great. Why? Because valuations are so high. Let me show you the 2 most reliable metrics. The first one is the stock market GDP ratio. And I laughed really loud when I saw somebody write on a comment. And I don't see the comments very often, but it happened to pop up on our YouTube Studio app. And it said, I stopped listening to this guy when he mentioned stock market to GDP ratio. And that's what made me think, okay, we're getting closer. Why? Because this, according to Warren Buffett, is the most reliable metric at any given time of stock market valuations. And where do we stand? As of the end of the year, 111% overvalued, which takes our fair value around 2,800. Now, does that mean we're going to hit that? No. Guys, I thought the market was overvalued when this valuation metric was 1,500, and stocks just kept going up in one of the longest and strongest bull markets in history. Now, for those of you who criticize the stock market GDP, saying it doesn't factor in where money is earned, blah, blah, fine. Let's go to the 10-year cyclically adjusted PE ratio, which factors in any earnings, no matter where it's earned. And guys, it's worse. It's 121% overvalued based on history going back to 1928. So, does this mean you should sell stocks? No. Because if you were an idiot like me and sold stocks back in the day after COVID, thinking it was the start of a major bear market, guess what happened to you? You missed out on a lot of gains. Now, do I think we're going to give up a lot of those gains? Absolutely. But your job is to focus on dollar cost averaging and a low cost ETFs. And if you choose to buy individual companies, you need to learn a principle driven investing philosophy, which is what we talk about on our channel. We want you to realize that every investment is the present value of all future cash flow. When you buy a stock, you're buying a piece of a business. We're not going to look at the market price in the short run to determine if we're right or wrong on investments. We sit here and buy good businesses at great prices. It's easier when stocks are down. I want to change your way of thinking into thinking about rooting the market on, rooting the red days. In our community, we have these people talking. Our community members love when the days are red because it's an opportunity to buy great companies at great prices. But remember, news follows the stock price. And the start of this year has not been great for news. Just today, Biden announced some sort of AI chip issue. And what did that do to NVIDIA stock? NVIDIA is down 2.6% today because of that news. Is it really mean the stock is worth $70 billion less? Because I don't know. But remember, these short-term things get people all riled up and excited. Don't make decisions based on the emotions of the market. Make the decisions about investing and putting your hard-earned money at work based on long-term fundamentals of a business. And in order for companies to sell cheap, they have to be selling at a price that most people think is a stupid price. But not stupid because it's so low, stupid because you're dumb probably for owning it. It's hard to find good investments in companies that everybody wants, that everybody thinks is great. NVIDIA is a great company. There's no doubt about that. The question is, when you pay this price today, when you pay $3.26 trillion for the company, which is essentially what you're buying here, what does the future have to be to make this a good investment? That's it. Because guess what? A real investor worries about how much they pay about investment, not just about what they're buying, how much they're paying for it. That's what really matters. Now, in this last week, CPI has been a question because unemployment rate came lower, which showed the job market was probably a little bit stronger than people thought. And that's unfortunately can be inflationary. There's been rumblings from some Fed presidents saying, hey, we might not only have one rate cut, but we might actually have rate increases this year, which is mind-boggling to think because everybody's been banking on so many rate cuts. Last year, we had 3 rate cuts for a total of 1 point. But in December of 23, the expectation was 7 or 8 rate cuts for 2 percentage points decline in the interest rate. But we got 1 percentage point decline over 3 cuts. We don't know what's going to happen. If all of a sudden inflation became 10% again, guess what's going to happen to interest rates? They're going to skyrocket. Now, the principle-driven investor is going to sit there and not care about that. What they're going to care about is, can I buy these great companies that have been affected for better prices? Because let me tell you something. NVIDIA is a great company. If NVIDIA needs low rates to be good, that does not make it a great company. It makes it a lemming, like everybody else out there. But you're not a lemming. We want you to be a great investor no matter what's going on in the markets. Here are all these major events that have happened in the last 50 or 60 years. All these were huge events. And these aren't even close to all of them. There's events happening every day, but guess where the stock market goes? Over the long run, as GDP goes up, as earnings go up, as revenue goes up, the stock market will go up if you pay reasonable prices. Now, the one thing I've been seeing a lot about lately is this. There are 20-year returns in the stock market. There's never been a negative return, including dividends, in the stock market over a 20-year period, going back to 1960. Because this is 1980, but it goes to 20 years before. All right. Does that mean it's never going to happen? No, but it just goes to show that the longer your investing horizon, the more likely you are to be successful. And I want you to remember that. I want you to, but we live every single day. We live in that emotion of every single day. So that's what makes investing hard. The numbers aren't difficult. It's sitting there and saying, I believe these numbers, even though the market's telling me I might be wrong because the stock is falling, because the market is falling. But if you're a believer in the United States, you believe that even though all these bad things can and will probably continue to happen, we will still figure out a way to get better. You know, I just recently bought Adobe stock, and the comments I receive are great. Oh, AI is going to replace Adobe. Adobe's going to zero because AI is going to completely replace it. Maybe so. I doubt it. I doubt that a $200 billion company or whatever it is going to go to zero because of artificial intelligence. I think it'll do better because of artificial intelligence. It'll make their products even better. And guys, earnings season is starting next week, and a lot of people focus on these small things. I want to help you navigate the market week in, month out, week in, week out, quarter to quarter. It doesn't matter. But that takes taking an outsized, higher level view. And if you really want that, that's why I want you coming back to the channel watching these videos. Because I talk about the same things in a different spin based on what's going on in the market. Talk about AI with Adobe. 3 years ago, it was electric vehicles. Before that, it was cannabis. Every single time, it's a different character, but the same story every single time. And guys, you know what I do? Every single day, I repeat the same things over and over to myself, the same basic things. And that's what makes me a better evaluator of companies. If you want to become a better principle-driven investor, if you want to have the tools that will make you a better principle-driven investor, go to everythingmoney.com or click on the link in the description below. We have our great software with all the tools up here to navigate economics, individual stock purchasing, real estate buys. Guys, I'm about ready to close on another real estate investment. Last year, we closed on $30 million in real estate investments. This year, we're in the first quarter alone, we're going to do almost $30 million in real estate investments, all from our real estate calculator right here. I want you to have those tools. Go sign up for $1 per day. Go check it out. It'll be one of the best decisions you make. But when it comes to this year, no matter if it's up 20%, down 20%, or better or worse, there's still something to be learned from every single aspect. That's when I learned the best after major losses. Everybody has it in them to be a great investor. Everybody has it in them to be a better investor. You just need to surround yourself with the right people. First step is watching this channel. Watch other channels too, and you'll gravitate to the ones that make the most sense to you. But we're here to navigate every market, and we're here to make every market, and we're here to make every investor better as markets decline. Because most investors out there actually only do well when the markets are up. That's not the way to be. I want you to do well in every single market. Thank you for your time.